folks, everybody is wondering, when is this stock market crash going to be over? This crash, this correction, whatever you want to call it. When is this going to be over? And so what we're going to do in the course of this video is we're going to go through the past 30 years in the stock market. We're going to go on a little history lesson, and we're going to find out how long crashes and corrections in the market usually last. Are we talking about this takes several years? Are we talking about this something that could be over in a few weeks or a few months? So we're going to go through that in depth. I'm going to give you my opinion on if I view this as a crash we're going through or if I view this as more of a correction we're going through, which is very important because what you're going to find out throughout this video is the way a correction is treated in the stock market and a crash is treated in the stock market are very, very different, okay? And so this is very, very important so you can have expectations around kind of where stocks are going and what to expect in this sort of market, because I understand like this is a market that, it's just destroying people. I would say I'm probably down. I'm down probably at least $1 million in the last, I would say 3 months or so, 3 or 4 months, down about $1 million. And so I'm just one of many people that have kind of gotten shredded up in this market. And anybody that's an investor, right? And especially if you're a stock picker and you've seen great deals, it doesn't matter that they're great deals. We've still gotten destroyed in the short term anyways. And that's just kind of the bullet you have to bite, I guess you can say, is being somebody that's an investor and you want to stick your head out there and invest in stocks. Well, when times are great, they're really great, and the money to be made is crazy, and the money to be made coming out of this mess is going to be ridiculous. But you have to go through these short-term time periods where you just got absolutely decimated. I saw this comment here today, and I see a lot of comments like this very recently. I think this has been going on for the last few months, just kind of a little more in the DL. Think people have kind of are saying it with their chest out now. Let's just put it like that. You ever seen that Kevin Hart skit? Say it with your chest out or whatever. And that's what I feel like a lot of folks are doing right now. I sold 25% of my portfolio and put half into silver and gold. No lie. What do I think about that? Well, first off, I understand it because you got to understand, like a lot of people, they say, I want this stock at this price. I want these stocks to dip. I want this stock to go down and I'm going to buy the dip. And then when these stocks actually go down, what we find time and time again, and this has been throughout history, is most retail investors don't actually really buy the dip. They don't really get enthusiastic when these stocks go down a bunch. There's just a lot of people that say, oh, if this stock went down, I would buy it like crazy, right? And then it goes down. And people are like, oh, no, because they'll make up excuses in their head to basically, make decisions like that. Now, I'm not saying that's a right decision or a wrong decision. It's just, it's interesting to see because last year at this time, people were talking about if this stock went down 5%, I'd go all in, and these sorts of things. And then now we see countless stocks down 50, 60, 70, 80%. And what we see is everybody leaving the market, not only not buying the dip, but selling these stocks at 52-week lows and many of these stocks at all-time lows. Think about that for a moment. It went from, I'll buy this stock, I'll go all in if the stock goes down to 5%, to these stocks go to all-time lows and 52-week lows, and people don't only make the decision not to buy, but they say, I'm done with the market, I'm selling out a portion, I'm selling out all my shares, whatever, and that's just unfortunate, but it is what it is, okay? Now, in terms of the Nasdaq here, Nasdaq year to date, and I was trying to think back to a January that's ever started out this rough since I've been in the market the last 14 years. I can't think of one. I don't even know if in 09, I don't even think in 09 we started out this rough. And I had a very, very small amount of money in the market back then, maybe, I don't know, $1,000 or a couple $1,000. And I don't even remember the market starting out that rough in 09. And so, literally, I don't remember we're 3 weeks into the year, and I don't ever remember the market starting out this bad. We're down over 7% on the Nasdaq right now. Over 7% through the first 3 weeks of trading. Yeah, like I said, I don't ever remember this bad of a start to a January ever. It's just been absolutely extraordinary. On the 1 year, we're still up 11% on the Nasdaq, but literally get 2 more weeks of this going on, 2 or 3 more weeks, and next thing you know, we'll be negative on the Nasdaq. It's incredible the rapid move down. As far as the Russell, the 3-month down 7.5%, and I pointed this out in a video earlier today. The Russell's flawed index, like all the other indexes, where the biggest of the bigs kind of hold it together and make it look better than this. If the Russell was truly, weighted in throughout the whole thing, I think the Russell would be down near 1,800 right now. But, Nonetheless, like all the other indexes, the biggest of the bigs hold the whole show up. And on the 1 year now, the Russell is negative. Negative on the 1 year for the Russell now. That's pretty extraordinary. You want to talk about the hottest thing in the stock market? Oh my word. It's the 10-year Treasury note. The 10-year Treasury note is the hottest thing in the stock market. The 1 year. Look at this. Up 73% performance on the 10-year Treasury note. Oh man, that's extraordinary. In all seriousness, look at the 1 month. Up almost 29% on a 1 month for the 10-year Treasury note. Those numbers are extraordinary. I mean, I don't know what other way to put it. Extraordinary. The 1 year, 73%, and the 1 month, almost 29%. Jeez, my gosh, is that a move for the 10-year? And then if we go ahead and we look at the 30-year, which I know we don't talk about the bonds that much, but it's a focus right now in the market. The 1 month for the 30-year, up 32.8%. Oh my, look at the 5-day, guys. The 5-day up 12. Oh, wow. That's all I have to say is wow. There's some moves in the Treasury bond market. And then the day when I look at this, I say, it's all a joke. It's all a joke. Am I going to make a decision to sell out of stocks at 52-week lows and all-time lows because the Treasury bond is up a little bit? Give me a break. The yield is still a joke. Just flat out, the yield is still a joke. If this is yielding 7%, 5%, 8%, different story. Totally different story. 2% yield? Give me a break. It's laughable. It's literally laughable. And the fact that money moves big on these little teeny changes in the 10-year, the 30-year, it's hilarious to me. That's the only way I could put it. It's hilarious to me because don't matter what, the whole yields are just simply a joke. There's no return on investment there, okay? Now, something interesting's happened very recently is what's happened with the Fed and the observations of what the Fed's going to do in this year in 2022. So if we go back 4 months ago to let's say October, there was an expectation from most folks in the market that there was going to be, and when I say most folks in the market, I'm not just talking about retail investors. I'm talking about hedge funds. I'm talking about institutional money managers. I'm talking about high net worth individuals. There was an expectation there was going to be 2 to 3 rate hikes in 22. Okay. Then we go back to 2 months ago, and there was an expectation kind of got raised to I think there's going to be 3 to 4 rate hikes in 22. Now you go back to December a month ago, and there started to become this expectation of 4 to 5 rate hikes in 22. And now here we are today in mid-January, right? January 18th as I'm recording this video. And now there's 4 to 7 rate hikes expected in 2022. And that's universally out there. Everybody I've seen that tries to put a prediction out there, everybody's between 4 and 7 rate hikes now. Okay. And those are assuming just a quarter point each. And there's even some folks that are saying, no, they're going to raise a half point each time or something like that. So the expectations are the Fed's going to raise interest rates massively. Now, those expectations, in my opinion, are getting way overinflated, and the expectations around that are getting way too extreme. Here's why. I feel like inflation, the inflation growth rate is going to slow massively. As we go throughout 22, inflation is going to go like this, in my opinion. Second thing is, remember, there's some folks talking about worries about the economy, right? Recession. You saw Elon Musk put it out there. You've seen some other people put it out there. Oh, maybe there'll be a recession in 22. Guess what? If there's even a glimpse of a worry about a recession in 22, they're going to go from rate hikes to rate drops. That's something I don't even think people are fathoming right now, right? And so there's there's a weird fear out there. There's this one fear about they're going to go crazy with rates and just throw them to the sky. And then the other side, you got these worries about recession. It's well, do people realize if you have a recession or if the Fed gets seriously worried about a recession in this country, believe me, they're not going to be raising rates. They'll be dropping rates like it's nobody's business, and the money printer is going to be going crazy again, okay? That's what ends up happening. And so, but that's what has essentially happened here very recently. Now, with all these changes, where do you think people are going to be 3 months from now or 6 months from now with their predictions and those sorts of things? But it can change rapidly when it comes to the market, okay? Now, if we go ahead and we pull up a 30-year chart. So what I did is I pulled up a 30-year of the Dow, but what you're going to find is the Dow, the S&P 500, the Nasdaq are pretty much all run about the same as far as going up, going down. The S&P is just kind of a little more volatile, what I found over time, than the Dow. And as far as a little more volatile than that, then you go to the Nasdaq. So the Nasdaq's kind of the most volatile of the three main indexes, okay? But I pull up the Dow since that's the one that everybody always looks at, the Dow, okay? The 30-year chart makes all these stock market crashes and corrections look very quick, okay? Even the vicious 2000, the 08, and the 2020 crashes just look like little blips on here. And I think that's important. And the reason I think that's important is because even the most vicious of the vicious stock market crashes can go pretty quickly in corrections. Now we're gonna look at these in detail and see what actually happened. And what you're gonna find is some of these lasted a lot longer than they really get credit for when you pull up a 30-year. Now, why do I like to look at a 30-year chart? Because that's the modern financial days, right? What it was going on 100 years ago in the stock market was just the companies, you couldn't compare them, the profitability, you couldn't compare them, where the United States was at that time, where the global economy was at 100 years ago. You can't compare those. So I don't look like the Fed wasn't even around back then. It was a whole different situation. So what I like to look at is I say, let's look at modern times, the last 20 or 30 years. So that's why I pull up a 30-year, okay? So first one we're going to find is the 1998 crash, correction, whatever you want to call it, right? It's kind of more toward a correction, but nonetheless, it was about a 1-month vicious crash where the market just went from about 9,000 roughly to, 7,500 or so in about a month's time. So that was a very quick crash, and then you started to bounce back. And it took about 5 months to get back to where you were prior to the crash. But yeah, that was one of those that a lot of folks at that time we're wondering, was this going to be the big tech bubble crash at that time? And what we actually saw was things went up from there over the next few years. But nonetheless, it was a very quick correction crash, whatever you want to call it, and then very quick to get right back to where it had been at previously. The next one up here is a 2000 through 2002 crash, which that started kind of, as far as the Dow at least goes, it started kind of in the mid to late year of 2000. Nasdaq started a little earlier because Nasdaq got it worse, right? So basically, this was a 2-year crash, and it spiked up sometimes and it gave you some hope. And at the end of the day, it just kept going down and going down. So ultimately, it ended up being a 2-year crash. It was a slow crash, and it was a painful crash because it didn't happen all at once. Sometimes look at the Nasdaq being down 7+% year to date. You could look at that as being like, oh man, it's so devastating. Sometimes it's better to just get the dang pain out of the way. It's like, would you rather have the Nasdaq go down 7% over the next 6 months, or would you rather have it go down 7% in a 3-week span, right? And let's just say we're in for a 10% correction in the Nasdaq, or let's say 15% correction. It's like, would you rather get that over with in a month or two, or would you rather have that play out over a 12-month span? For me, I'd rather let's just get it over with, man. You know what I mean? So that's kind of the way I view this here is, it was a 2-year crash. It was very painful and it was a slow crash. Now, it took about 4 years to get back to, where we were prior, right? In the 10.5 plus range, it took about 4 years to get back to that place. So not only did you have to go through a painful crash, but you had to kind of, it took you a while to get back to those prior highs. Now, I'm going to bring up a really interesting point on one of these next slides here on something they don't ever tell you, okay? The 07 to 09 crash. So that one started in mid to late 2007, and then it ended around February, March of 09. So it was about a 1.5 year stock market crash, right? From Dow 14,000 to Dow 7,000. I think the bottom was technically 6,700 if I recall during that time period. So it was about a 1.5 year stock market crash. And it took us about 5.5 years. 5.5 years to get back to where we were prior to, back to that, 14,000 level. Okay. That's rough. That's rough. Now, there's a lot of reasons why it took us so long. I mean, some people blame it on the Fed stopped all liquidity in the market for way too long. And that sent the whole banking system into near collapse, right? Where a lot of the banking system did end up collapsing and a lot of it almost collapsed. And because of that, it took us, way, more years than a lot of folks expected to come back. Then on top of that, you had real estate crash, which usually real estate doesn't really crash. Usually real estate, if anything, it might go through a correction or something like that. But usually real estate doesn't crash in terms of real estate sales prices. You had real estate crash, which is where most people's wealth is tied up in the United States. Then you had the stock market crash on top of that. You had high unemployment. Then you have a lot of folks that blamed the administration at this time, the prior administration and the new administration for a slow recovery. So nonetheless, there's a million different things you can pin that on and why it took 5.5 years roughly for us to get back to where we want it to get back to. But it took us that long, right? And like I said, it was about 1.5 years of just a vicious stock market crash. Now, what they don't tell you when you go about going through one of these crashes and those sorts of things is, what if you had been buying all along, right? So as the market's crashing, you've been buying. As it's dipping to all-time, or new lows, you could have been buying. As it's coming back, you could have been buying. You could have been buying your favorite stocks during that time. And you ultimately would have made out with it like a bandit. And then goes for every single correction or crash. And that's the most frustrating thing for me to see in any corrections or crashes we have in the stock market, is the fact that people don't really buy the dip. You got a few select ones, and shout out to you guys that really are, hold strong and you buy throughout these dips. But most folks, they don't buy during the corrections and they don't buy during the crash. So the way they view it is a very naive way. It's like, well, I bought here and it took me 5.5 years to get my money back. Nah. Because you were buying throughout all these years. And so by the time you get back here, oh my gosh, you've already made a fortune. Even if you bought at the peak, as long as you were buying all here, by the time you get back to that place, you've made so much money, it's disgusting. Okay? Because during a crash, especially when it comes to growth stocks, they're the ones that get hammered the worst. And those when they come back, my gosh, I've seen it time and time again throughout these crashes and corrections studying history where they come back 30% in a week. And over the matter of 3 or 4 years, they come back 100, 200, 300, 500, 1,000% over the course of a few years coming out of these situations. This is why when, I got in the market 08, 09, I had very small amounts of money in the market and I was investing in the safest of the safe companies. And I should have been investing in growth stocks because those are the ones that are devastated. Who cares about Conagra Foods and Walmart stock and those sorts of stocks? Those are stocks that I view as those are the type of stocks you go into if the market's, if you can't find any good deals in the market, right? Hide out in some of those safety stocks. But in terms of, Kimberly-Clark and all the others, Procter & Gamble, Johnson & Johnson, but in terms of when you're crashing, man, let me tell you, there are deals all over the place in that sort of market. And that's just, like I said, it's unfortunate to see that most folks leave the market during these crashes and the corrections. Because I'm like, if they just were dang buying, oh my gosh, they make so much money. It's like, nobody's business, okay? Now, we also had the fall of 2018 correction. So that was a vicious one. That tore me up a lot. I know that tore a lot of people in my prep stock group up that were in the market at that time. And I remember during that time, we lost half the members of the private stock group during that crash, where people just were getting devastated and they were just left the market. Unfortunately, it happens time and time again. It's like it just goes in cycles, man. It's just like, it was such a great time to buy so many great companies that were phenomenal prices. Nvidia was, oh my gosh, Nvidia since this time during this crash is probably up, 500 to 1,000% since that time. Like everything. It was like shooting fish in a barrel. But anyways, we bought them in December that year. It's kind of toward mid-December is when we bought them. Actually, no, it was late December. I think it was December 23rd or December 24th we bought them, technically, okay? And Dow bottomed at 21K. And we were at 26.5 prior to that. So it was about 5 months to the bottom. And then it was about 10 months total to get back to where we were prior to that period. And like I said, that one was really, really vicious because, it caught a lot of people off guard. It was one of those that just no one was really expecting. It came out of nowhere and it just shredded people in that type of market. It was pretty darn vicious. And like I said, man, if you were buying, oh my gosh, you look where Tesla stock was valued at that time during that crash. Look where Nvidia stock, look where AMD stock, look where any of the great companies were valued during that time versus where they're valued at today. And it's like night and day. And it's just unfortunate. And that's even with the market pulling back as hard as it's pulled. So yeah, the name of the game is when you're in these corrections and crashes, it's to buy them, man. Then you had the Rona crash, which is the latest crash we had, which basically the S&P 500 fell about 35% in 22 trading days, which made it the fastest stock market crash we ever had. So it was about a 3 or 4 month span till we bottomed. Right? We bottomed there at 21K-ish. We went from 28 to about 21K in a matter of 3 or 4 months. And then it took us about 7 months to get back to where we were prior to the crash, essentially. Right around here, we got back to where we were prior. So Rona crash, definitely very, very quickly. The Fed helped huge in that situation. I think we would have been looking at, we could have went to 20, 30% plus unemployment numbers if it wasn't for the Fed, in my opinion, backstop in that situation, doing everything possible to make sure we didn't end up in a Great Depression in this whole scenario. Did we end up with inflation? Yeah, we ended up with a lot of inflation. But it's kind of like, do you want a Great Depression or do you want a 7% inflation? It's like, what do you want in that situation? So that was Rona crash, right? So what we're going to find here over the last 30 years is we had the 1998 and the 2018 corrections. We had a time period, which I didn't show, in 2010 through 2011, which was kind of like almost corrections, I call them. Those were like double dip recession fears we had. Oh, it might be the double dip recession. Then there was, presidential election in 12 that made the market very volatile in the short term. There's definitely a lot of folks in the market that didn't want Obama to get a second term at that time. And based upon the recovery and how folks felt it was really, really slow recovery. So there was a lot of folks that didn't want Obama in again. The market was very volatile during that period as well. And so, yeah, we had, what I would call almost corrections during that time. Then we had the 2000, the 08, the 2020. Those were structural crashes. When I say a structural crash, there was something epic going on that caused us to really just have an overall crash, right? In the 2000 crash, you had crazy valuations on stocks that didn't really have business models, literally pre-revenue companies pretty much just trading at insane valuations. Then you obviously had all of a sudden wars start during that time period that the U.S. had to focus on these wars. 08 was a structural crash because you had real estate stocks crash, unemployment super high, companies laying off employees left and right, and a slow recovery. And then you had the 2020 structural crash, which was very, very quick because the Fed backstopped it. But that was obviously we're shutting down the economy overnight. Okay, so what we're going to find is the crashes last quite a bit longer, other than the 2021, than correction scenarios. So as far as 22, what do I feel about kind of 22 in my personal opinion? I feel, and then I want to get into this here, something I posted in my private Discord chat. I view this as much more of a correction than a crash. It's always possible the whole economy tanks, and next thing you know, companies are laying off massive amounts of employees. It's always a risk. And that's something I'm always prepared for. And I'm always like, my thoughts on that is, if that's a situation that plays out, that's a situation that plays out, okay? I don't ever want to fear that because those time periods are very few and far between. And I understand that the Fed's usually going to do whatever the Fed has to do to make sure we don't end up in a situation like that. And we saw that played out firsthand in 2020. And so that's just something okay, whatever. So I view this more as a correction scenario where large caps have been trading rich. They need to come down to more fair valuations. And small caps have gotten way over destroyed in this whole situation. We know that small caps are trading disgustingly cheap. Mid caps are now trading insanely cheap. But you gotta, the large caps have just been out of whack. And I think we've just been waiting for large caps to finally get some devastation. And what we're seeing is that play out with the Nasdaq down over 7% year to date. That's some devastation playing out. Cause like I said, I've been doing this for 14 years. I don't ever remember us starting out of January where the Nasdaq just shot down 7+% in a matter of, the first 3 weeks. That's nothing short of extraordinary, all right? And so I think if we go back and we look at history, this is something that should last anywhere from a few more weeks to maybe a few more months max. Now, there's a lot of folks in the market that are, stock market experts or whatever we want to call them, that feel like the second half of the year is going to be really strong. You see Tom Lee say this. I've seen a lot of, what I would call bullish investors say, hey, front half of the year, very volatile. It's, a lot of people are going to get shaken out of a lot of stocks, some big falls. Look for volatility in the front half of the year, not really much happening in the market. Maybe some huge upswings, maybe a lot of massive downswings. But everybody's there's like a consensus out there that the second half of the year is going to be very, very strong. So in my opinion, I think we're, outside of a structural crash, I can't say we're anything other than maybe a few weeks from maybe a couple months away from a bottom in this whole scenario. It just, there's so many of these valuations. At the end of the day, the market can only stay irrational for so long on the upside and the downside. And when I just look at so many of these stocks, they've just gone to irrational prices now, just straight up irrational prices that don't make sense anymore, where it's just like this stock is trading at this price. Look at their growth they're going to have over the next 5 years. Look at their revenue growth, their net income growth, we're just in that sort of market that's kind of throwing all these stocks out. That can only last for so long. And eventually, what does everybody want to hold? People want to hold growth stocks, man. The market's going to come flooding back to growth stocks like it's nobody's business. That's what always ends up playing out, right? Now, I posted this in my Discord chat late last night, right around midnight or so, in the breadcrumbs tab, and I said I've seen an interesting phenomenon in the past year. Last year at this time, I witnessed many growth investors bragging about their gains, putting value investor and index fund investors down. Now that growth investors have been destroyed, I've seen countless value or index fund investors brag about their gains and put down the growth investors. Because obviously, if you were just in index funds, you did pretty well last year. However, if you're in growth stocks, you got decimated. I see this activity on YouTube comments, forums, message boards, and I've even witnessed it here in the private stock group a few times in the past year. The truth is, value investors, index fund investors, and value investors, index fund investors, and growth investors are like two groups in totally different religions. Hard to get them to see eye to eye. Many growth investors have the attitude of, good luck getting rich, you old grandpa, by buying these value stocks and index funds. Your grandkids will enjoy that money because you'll be dead before you can ever get to use it. That's the attitude of a lot of growth investors, unfortunately. Many value investors have the attitude of, good luck buying those growth stocks, kid. Those non-profitable companies are worth nothing because they don't make any money on the bottom line. And those high PE stocks are way overvalued. Just wait till a crash. You're going to lose all your money gambling on those companies. As for me, I say, why can't one be both? If value stocks are a great value, then why not buy? If growth stocks are a great deal for a long-term investor, then why not buy? The goal of the stock market is to make money. Well, if you know how to do both, you'll end up making a lot more money over the next 10, 20, 30 years versus only knowing one. A complete investor, in my eyes, is one that can explain why Coca-Cola is a good or bad deal and at the same time explain why Shopify is a good or bad deal. Lastly, respect all investors and never laugh at the other side because you can be humbled very quickly. Just be grateful, give others respect, and call it a day. And that's basically what I have to say on that subject, because I witnessed what was going on last year. I witnessed what's going on this year. And, for growth investors laughing at value investors because they only got such and such return and you got a much better return, it just doesn't make sense. At the end of the day, things can turn really quickly and growth stocks can get destroyed. And that's exactly what we played out. On the value side, if you think you can't get devastated as well, believe me, you can get devastated as well. And also, things can flip very quickly and all of a sudden growth stocks are back to trend and all of a sudden you're looking at your returns and saying, I got a 5% return this year and these kids on Wall Street bets got, 55% returns. So that's why I say just give everybody respect, learn both disciplines the best you can, and go from there. That's my message for the day. Much love as always, guys. If you want some free stocks from Moo, check out the pinned comment down there. Get up to 5 free stocks valued up to $3,500 each. Don't forget to subscribe to this channel. This is Financial Education 3, and have a great day.